All right, so this morning we are looking at the inventory management integration into SAP, and we've seen how the relationship between SAP as an enterprise system and the organization. So past lectures have delved into those connections and how SAP is helping businesses run. So an integral part of any business organization is its inventory. And it is very important that we talk about inventory as it is. So in this class, we'll look at an introduction to what inventory management is, taking an example of the Zinebike inventory challenge. We'll look at the organizational structure of inventory management in the SAP, master data, the inventory management process, and we'll look at inventory management reporting and documents that are generated. So there are one basic thing about inventory is the movement of goods movement. So what happens? Now, let's look at what inventory is as a term. So inventory stands for an organizational resource, any resource that can be sold, that can be used for manufacturing, or that can be used for providing a service. Any resource that is being transformed into the final product. Any resource that is being added as an auxiliary to the product, or any resource that is used up during a service operation, or can be classified as inventory. For example, any organization that you can think of, you see a level of inventory. Okay, let's take the university system. You have the department. So one most important inventory that we must keep as an institution of learning is books. We have to keep books. So these are used, students can go to the library, pick up a book and read. So that is the level of inventory. So you stock anything you stock up that helps the running of your organization or that is being transformed. So it is recorded as an asset. Yes, because it involves financial statements, it involves financial transactions. These things are bought with money. They have financial value. There's a unit price that is attached to it. So once an organization sells that inventory, that particular inventory, it's going to generate money. So there's a financial backing to it. So inventory items include all costs incurred to get that particular item. For example, if you are a farmer, you have planted maize. So everything that is incurred from transport to where you got the seed, to hire of tractor, to everything, will be converted on unit basis of your product that you harvested. So that is the unit price or unit value of that item. So inventory covers everything around the product that is ready for sale. So why do we need to manage inventory? Inventory can mess up your organization. Yes, there's a minimum level of inventory you should keep so that when your customers come and request for a particular product or a particular good, it's available. And you don't have to keep the whole entire world of inventory. So there is a maximum you should keep. There's a maximum you should keep. So basically the maximum is your store size. What is my store capacity? What is my production? If you keep too much inventory, you are tying up money, value that can be used up for other valuable services. So you tie up money, you keep too much inventory. Or some goods are they are slow moving. Very slow moving. So if you pack up such goods, you are only tying up money, and it will take a while for them to be used up. And if you are dealing with perishable items, and you now stock a lot of that perishable item, then you are bound to lose money. So to prevent inventory losses, you have to have what is the minimum that I should keep so that my customers are not disappointed. My production is not stopped for the sake of there is no raw material. So every component, for example, if you are dealing with car production, how complex it is, you all know that if there is a short of bolts and nuts, then production will not go on. So for those parts that must be coupled with, so for with nuts and bolts, so that item must be managed so that um production process is not stopped. Because if you stop production, you are still paying the salary of the workers that are still working. So it is very important we manage inventory, minimum, maximum allowed, and also to ensure that financial statements are correct. Are correct. Very important. You need to take stock count of your inventory such that we said an inventory item has value, it's an asset to the organization. So if an inventory is lost, then money is lost. So there's a financial implication to it. So definitely we have to manage inventory. So we're going to look at the design bike case study as it is as the organizational structure level. Now, we all know that the design bike case study that we are using belongs to the global bike group. So design bike, the global bike group is the client. So the company code is design bike company limited with two plants. There are two plants under the design bike company code. So a company code can have more than one plant. I think we've established that a couple of times. So we have two plants. We have the Lusaka and we have the Mungwe. So what is the challenge? Now in Lusaka, Lusaka does not deal with raw materials. So it doesn't have store for raw materials. Why Mungwe does not have a shipping port. So the level of inventory they keep will differ, differs. For Lusaka, that does not deal with raw materials. So you can't have a processing plant, a production plant there. So it's going to affect the structure of that plant. So for Mungwi, that does not deal with sales or shipping of items. So you do not have to keep a large warehouse of finished goods. So once those goods are finished and they are well packaged or they are in the semi-finished state, they are for a little while transported to Lusaka. So Lusaka does a lot of so storage for finished goods in Lusaka is expected to be bigger. So the inventory management system for finished goods in Lusaka is expected to be more robust compared to that of Mungwi. So while Mungwi will deal with more robust system for handling raw materials inventory. So the type of inventory available in that plant affect its operations. So Mungwi is more with external vendor of raw materials, while Lusaka deals more with Mungwi plant in terms of the finished product and semi-finished product and the customers. So Mungwi will deal with more of a vendor that is going to sell me the raw material. So what they are dealing with is raw material. So we have a large stock or differentiating raw materials as against finished product. While Lusaka would have a large warehouse that would deal with semi-finished product, trading goods, and all that. Remember again, Mungwi doesn't have a trading goods. Don't have trading goods. So these are how the dimensions of your inventory can affect the plant, and the operations of the organization. So that is at the organizational level. Now, what happened as the master data view? So the master data view has to do with so many data that are stored centrally in the SAP platform. So under that, we see the material master. So the material master has a lot of data that are embedded: sales data, warehouse management data, material plan data, forecasting data, storage data, quality data, and so on. Now, for an inventory, not all these data are required at the time. So the ones highlighted are the basic ones, some of the basic data that are required for an inventory. The basic data talks about the name and so on and so on. The storage data, where it is located, where is the storehouse that is located, where the product can be located, and accounting data. So if I have 10 bicycles, finished product in my store, so there's a unit cost attached to that bicycle plus my profit. That gives me the selling price. So there is an expected amount of money that is to be made. So that is to be reflected into as an accounting data. Now, in a general format, the material master views have your basic data. As you said, you will see the client's name, that is the global bike group as it is, and you see under that, you see the name, you see the company code, you see the weight, you see unit measure of that particular product. So basic information that talks about the entire organization. Accounting specific information. Now, accounting data is maintained for each of the plant. For example, from what we have on the screen, you see plant LU00. That talks about the Lusaka plant. So what is the value of items in Lusaka plant? What is the item cost price? What is the valuation in terms of the asset to the company? Now, a plant will have storage location. The storage location, FG00, finished good 00, storage location TG00, which is another location for trading goods. So semi-finished goods has its own storage location. Storage for miscellaneous and all that. So specific items are stored in specific location, storage location. So we have the general plant, we have the storage view, has storage location, specific information. And each of them will have the stock quantity. Very important. Stock quantity multiplied by the unit cost as it is, or the unit price, selling price of that item will give us the valuation is in as an asset for the company. So what are the different stock types that you see in the master view? You see valuated stock. So, and this is determined by the fact that is the inventory to be sold or to be counted. So valuated stock, unrestricted use stock, stock in quality inspection, blocked stock, stock in transfer, then stock in transit. So these are the different categories of stock. So at a point in time in the production, a particular stock can be transformed into another type. So a stock can move from being evaluated to unrestricted. You can move a stock from unrestricted use to stock in quality inspection, depending on the movement of that stock. So we're going to look at stock movement. So the master data controls information are maintained centrally. So once it is maintained centrally, that implies that there is a level of authorization that is involved. So somebody like a storehouse manager cannot just move a particular good and delete it from the system. So there's a level of authorization that is involved. So once a movement is made, certain data in the system are automatically updated. And that is why what is meant by is maintained centrally. So if it is attached to finance, if it's a movement of goods out of the company, then there is finance that should be updated. So all changes are visible. All changes are visible. So if the goods is moving from one level or is changing, then at a particular level, certain documents are updated. So that is the master data maintained centrally. You can't just delete because it has reflected. So you can't just delete, you can't just change figures, you can't just inflate figures on the system. So let's move on. Inventory management process. So enterprise use the perpetual inventory system. So that means that you employ somebody, there's somebody that is called a storekeeper. What is the job of this young man? He goes into the store every day and takes count of the stock that is available. And that stock that is both living and both entering. There's a daily record of the stock, both entering and leaving the organization. So there is periodical check. If there is a movement, immediately it is noted and he updates the system. So if a goods is entering, is what he collects the value and also updates the system. So and it's done daily. So that's a perpetual inventory system. It's not accumulative. Okay, by the end of the month, we're going to take count or we're going to enter. So it has to be a daily record. So recorded as goods movement. As goods are moving, there's a record, there's an update in the system. So a stock transport order can be used to request stock from one plant to another plant, like the case of Lusaka and Mungwe. So a stock transport order, Lusaka needs a particular finished product from Mungwe. The customer has placed the order and then they need that particular, or peradventure, the number of bicycles, finished bicycle in Lusaka has dropped beyond acceptable minimum limit. So what is that? What Lusaka would do is to generate a stock transport order to Mungwe to transport particular product. So transport order is for movement of goods from one plant to another is generated. So inventory, that the stock counts, are a control as they highlight inventory risk. Now, what are the inventory risk? If you don't take count, you can lose inventory. Someone moves a particular product and you are not aware until maybe account does not balance. It's possible. But when there's a daily count, yesterday it was 50 and we moved 20. So we're expecting 30, but we are seeing 29. Then something is wrong. So we can easily track when the reduction came about. And also incorrect goods receipting. We have ordered 50 products. We delivered 49 in error. But because we counted, immediately we will know so that when we are updating system, we are not updating 50 instead of 49 or 49 instead of 50, depending on which is the goods receipt. So goods receipt can then be reconciled back to the vendor. Oh, we received 49. We ordered for 50. And we are paying for 50, not 49. So there's going to be reconciliation on that because we took inventory. So that is the management process. So inventory is counted daily Inventory is requested from plant to plant, and inventory must be counted to highlight inventory risk. Now, when a particular goods move out of a plant or into a plant, documents are created, material documents. So an accounting document is also created if the goods movement needs to update finance. So not all goods movement update finance. But we all know that once a goods is moving, documents must be created, depending on the level. So it could be movement of raw materials from the store to the production floor. A material document must back that up. Oh, we have moved 50 to production floor. If you are moving a finished bicycle from Mungwi to Lusaka, then a material document must be created to accompany that. Finance is updated because it has been transformed from raw materials to finished product, so the value has increased. So there is delivery note, you see purchase order. Purchase order is under procurement when you're getting raw materials from a vendor. So purchase order, you see delivery note, external vendor or other plant, get from external vendor or other plant. Material document to goods receipt area. So you see products coming in as goods receipt from purchase order, from delivery note, from external vendor. And you see goods moving out of the goods receipt as material documents for goods receipt. You see accounting documents. So accounting is updated. Material document for goods receipt is updated. So materials document is reflected in the store. Accounting document is updated for payment. So goods movement is just as an example of how goods receipt can trigger certain transaction or movement as captured in our document generated. So goods movement can update FI. Now, what are the possibilities? The accounting document contains relevant information post to finance, such as the document date, posting date, the group general ledger account number, associated amount, company code is derived from the plan. So if there is a goods movement that needs to update FI, so we need to see the document date. The date is attached, the posting date is attached, a general ledger account number is generated. So that can be shared across the financial transaction. Amount is reflected, whether debit or credit. For debit, I think you've done that under your accounting, when to debit and when to credit. So for every update in finance, then there is either a debit or a credit. So company code is derived from the plant. So automatically, financial transaction takes place at the company code. So company codes are reflected from the plant. Now, a question here for us is that which of these would generate an accounting document? Which of these can generate an accounting document? Let me just give us a simple example. Let me use the ATM machine. For example, as a client, you have money in your bank, but the cash note as it is not yours. It belongs to the bank. So that is an inventory from the bank. Stack money in the ATM machine. So when you go and withdraw from the ATM machine, you punch in your password and all that, your account is debited. You receive your cash. So most of the time, especially in this part of the world, we don't do with receipt. A receipt is printed immediately. So it asks you whether you want to print receipt or not. And you said yes. And you click on that yes, and it prints a receipt that backs up the transaction. So while the amount is reflected in the bank's account, is supposed to increase. So that document is generated as a receipt, indicate the amount of cash, the value of the cash you collect. So that is an example of a typical example of goods movement and also the transaction that are involved. So now we are looking at this list. So there are 4 types of goods movement here. I'll try to explain each of them as best as I can. The first is which of these, the question is which of these will generate an accounting document. Now, number 1, goods receipt of material from a vendor. Goods receipt of material from a vendor. Will that update without generate an accounting document? Anyone from the class, yes or no? Yeah, just yes. Will it generate an accounting document? Yes.
Yes.
Okay, thank you. Yes. Because
Yes, sir.
yes, because as a vendor, and the vendor is external to you, there is a goods receipt that you must pay for. And there must be a document that indicates what has been done. And that goods, so the document that will capture the vendor's name, the quantity you have supplied, his unit price per item, then the valuation. So goods received from a vendor will generate an accounting document. Number 2, goods receipt of materials from another plant. Now within the same company code. So when we say another plant, it means within the same company code. So will it generate an accounting document?
No, it shouldn't, because it is not changing the financial position of the.
It's not changing the financial position of the company because the material is still within the same company code. So it's just from one plant to another. So it's unlikely that this kind of material movement will generate an accounting document because that plant it is going to, it will not pay. So Mungbi will not pay Lusaka. So I hope we got that. So Lungbi will not pay Lusaka. Neither will Lusaka pay Lungbi for a movement of transaction that has been done. It's just going to be produced in Mungwi and shipped to Lusaka. So that's a typical example. And the accounting document will not be generated, though a stock transport order will be generated as a backing document that shows the amount of goods that have moved or that has been requested. The third one here is goods issued to a customer. Yes or no?
Yes.
Yes.
Yes, yes. So goods issued to a customer will, because the customer must pay. The customer must pay for what is being issued as goods receipt by the customer. So the last one is scrapping stock. Will it generate an accounting document?
No.
No.
I think yes.
Okay,
I think
yes.
yes.
Yes. Okay. Hold on, please. For the no answer, is there a reason why? Can you justify that? Why do you think it's a no? Yes, any justification for that? Okay. For yes. Any justification for yes? Why yes?
Okay, so I think yes, it will, because the valuation of that material before will be higher than what you are scrapping it to.
Yes, correct. Thank you very much. Now, scrapping has a lower value, cost average value. It has a lower value compared to the initial cost for that product. So since there is a drop in value, accounting document must cater for that. So if we are scrapping this a particular amount, So that must be reflected in a document. There must be a document that backs that up. So if we are scrapping to zero, there must be a document that shows that this particular stock, especially for perishable goods, this particular stock has left the company or is leaving the company. So there must be a decrease in valuation of the entire goods in the company. So an accounting document must show that. So thank you very much. So goods movement and the material master view. So material document can update material master. Yes. So the quantity in storage location must be reflected and must be updated in the material master data. So a material document for a transport order between Mungwi and Lusaka must reflect it in the material master for Mungwi. What has happened? We have shipped 50 products. It also must reflect in Lusaka plant. We have received 50 products too. That's why we said a material document can update in terms of the quantity of material in the storage. So there is a reduction in one plant and there is an increase in the other plant. So the valuation of material, yes, in particular for if you have issued a product to a customer, so there must be attached, there must be a cost that has been attached to that material. There must be a value of that material that the customer must pay, and that's the valuation we're talking about. The unit price quantity that has been issued to that, or in the production plan from raw materials that has been transformed to finished product. So movement has taken place. So there must be a kind of update as the final finished product. So there's a reduction in the raw materials in the store issued to plant. So there is another finished product leaving the plant to the warehouse or as trading goods or as finished product. So the valuation has changed. So that must be reflected. So material valuation, standard price or moving price. Standard price, so these are just ways of valuation. Theta is going to be standard price, going to be moving price. So for moving price, that's total cost for all items divided by the number of items, just like the average. So it's the valuation of the total items divided by the number of items, the total cost divided by the number of items. Recalculated for goods movement with vendors. So these are just a strategy you can use in your so for the material master data, as you see on the screen, you see certain information: plant data, storage location 2, accounting data 1, accounting data 2, costing 1. So these are various, they contain different information or they store different data as regards the product. So under the accounting, you see the material we're talking about, ZMTP1098, which plant? Mungwi. That's at the Mungwi plant. You see the basic unit of measure. You see the division where it is BI, which is bicycle. Then you see valuation class. You see the moving price. You see the standard price. You see the total value. So how do we get the total value? Total stock multiplied by the price give us what it is as 1,150,000 as the value. So these are the information, and these things are generated automatically once it has been updated in the system. Okay, we'll pen this for now. This is just a workshop we are going to deal with tomorrow. So how you post stock count, how you display stock value, and so what we've been discussing since the beginning of this class will be reflected. How you see certain information are being transferred immediately to other levels, the central control, and also the updates in finance from transport order, display order, goods receipt, and so on. So we'll look at that tomorrow. Yes, so let's move on to a stock transport order. We said a stock transport order is a document that you generate requesting for goods or initiating goods movement. Two plants, issuing plant, let's say Mungwi, tentatively. Receiving plant, let's say Lusaka. The issuing plant has what is called a particular storage location that contains unrestricted stock. Unrestricted stock are the stock that you continually use for production. There is no restriction to its use. So it is always available. Always available. So these are stocks that you use for as raw materials for transforming into final product. So in the issuing plant, you have lots of them as a production. For example, Mungu, which is the production site, has a lot of unrestricted use stock because production has to go on. So goods issue moves from the issuing plant transformed into a stock in transit. Now, stock in transit, these are goods that have left the issuing company but has not yet arrived at the receiving plant. So stock in transit has reflect the quantity that is being moved from the issuing plant, but it's not yet received. So the receiving plant has not yet acknowledged it. So once the goods is received at the receiving plant, there are three possibilities here. It still becomes an unrestricted use. For example, semi-finished products that are being coupled, that are being reassembled to produce the final product, unrestricted. Or it can move to stock in quality inspection. Now, what do we mean by stock in quality inspection? These are stocks that you use for quality check, quality assurance. Usually, they don't add value, in quotes now. They don't add value to the production. In short, these are products that you can either scrap. So these are quality, stock in quality, or it becomes a block stock. A block stock can be a stock that is damaged, you can't use. In the process of broken, it is becoming a block stock. So these are the three possibilities that can happen in any receiving plant. So, and there are implications for any of this movement. Now, let's say a more elaborate type of movement. So in this place, we're looking at both the vendor production and the customer. So in the previous example, we're just looking at one plant and the other plant. And now we're looking at the many types of movement. So the number one movement is we have generated a PO, the vendor has supplied us. He has supplied the product. The product can either be and come in as unrestricted stock and come in as stock in quality. So we have unrestricted stock. Unrestricted stock can be, some stock can be transferred to stock in quality inspection. Some can be transferred to as blocked stock. And also, block stock can be transferred into stock in quality inspection. For example, the product that we thought was bad, we have worked on it, we have repaired it a bit. So it can be moved to quality. From quality check, it can be moved to unrestricted stock. So within a storage location, there can be movement of goods. Also from production. For example, Mungwi to Lusaka. So production, you have your produce, you have your goods that have been transformed to the final product. So that is transferred into another plant. So that goes into the unrestricted stock. And also within those stock movement, within that plant, or within that storage plant, within that storage location, goods can be transformed from one type of stock to the other. So we've seen goods movement 1 and goods movement 2. Now, from plant 1 to plant 2, there are two possibilities. So You have 5 and 6. Goods can be moved from plant 1 to plant 2 using your stock transport order. So storage location 2 or storage location 3. Storage location 2, say in our Mungi plant, can be likened to the storage of semi-finished product. So this is where you now assembled the bicycle frame, the bicycle tire, you assemble everything to produce the finished goods. So the finished goods will now be moved through movement 7 to the storage location, which has to do with finished goods. So since we are dealing with finished goods, customer only buys finished goods or trading goods. So that gives us movement number 3 as when a customer generates a request order, a request for a particular product. So that is now moved from storage location 3 down to the customer. Or even within plant 2, goods can be moved to production. Storage location 2, as we said, as assembly, can be moved to production where you do assembly and then can do finishing or painting or whatever kind of value addition you want to do in plant 2. So within a plant, there could be multiple storage, more than one storage, as we see here, storage 2, storage 3. Goods can be moved from storage 1 to storage 2, depending on the value that has been added to it. And also, in storage location 1, stock can be transformed from one type of stock to the other. So these are the various types of movement that are possible in a company code. Posting stock count. So the difference between stock count and book inventory is posted. So the material document updates the material master. As we said, we have done the counting. We have it. We need to update the material master. So after we have done counting, there must be the particular value of inventory that we have. And that must be balanced and backed up by goods movement. We have received goods from our raw materials from the vendor. So there must be a material document. And also, when we count, it's the same thing. So we need to update the material master by adding the values, increasing the values at this case may be. So the inventory general ledger accounts are updated via an accounting document. So difference in list, we see difference in list. Now, if you look at the red circle, that is called the inventory tolerance group. So the minimum postable amount at user. We are expecting 50 to be in the store. We have 49. Okay, 49 is still okay. So that's the tolerance of 1. So if there is a tolerance beyond a particular level that has been set, then there's going to be an error. That's part of the controls that are embedded. So material documents are created. Material accounting also are created. Built-in inventory management controls. Inventory counts highlighting correct goods movement. You can easily see that. We have received 100. We had 200. So 100 plus 200 must give us 300. We are seeing that the difference of 5. So inventory count will highlight incorrect goods movement. That needs to be performed by a different user. So there's segregation of duty. So it's not the man receiving the goods or the man in account that should be doing the counting, so that he's not manipulating stuffs. So there have to be different users. There must be segregation of duty. Accounting will handle accounting. Warehouse manager and storekeeper will handle storehouse. So, and both accounts must be balanced control. So different posted need to be within tolerance set per user. So there must be a tolerance. So what is the difference of, if the tolerance is set at 0, so that means that every instance of time, the inventory must be the same as that which has been counted as reflected by the goods movement. But remember that we said every movement must be backed up by a document. So if there is coming in, there must be a document. If there is going out, there must be a document. And those must be reconciled. So once you post a goods movement, you can't delete it. You can't delete it. So goods movement is always reflected. You can't delete it. That is why you have to be careful. Some important reports. So managing and reporting on inventory will generate some certain reports. Yes, the first one is low stock levels. Since we are doing the perpetual counting, we notice that in a particular day, there is increase in production. So production rate has increased and is not balanced with supply. So there's going to be a level where there is a depletion of inventory level of the inventory. So you can easily reflect that because there are backup documents to show that these goods have been moving. And it also shows slow and moving fast stock. Oh, we used to use up the boat faster than the metal sheet. So inventory counting would reflect that. Lost stock, as we said, what happened? In the process of movement, was there a decrease in stock? So lost stock can easily be what? Deducted in this. So document list. What are the documents? Material documents. Yes. What is moving to where? Where is it moving to? Who is getting this? Who is responsible for this particular stock that we are dealing with? Accounting document for material documents. Accounting document for material document. So material document must reflect or be transformed into as the case may be. For example, goods received by the customer. There must be payment. The accounting document must be generated. Cancelled material document or reasons for movement. So different document list. Total quantity stroke value of stock for different master data are reflected. You must reflect that. The total quantity, very important. So the whole essence of documentation is to reflect the quantity that is moving. So that every point in time, it even has to do with quantity. So the quantity is reflected. Inventory levels at all levels in the organization hierarchy that are relevant to the stock. So since warehouse is in charge of keeping this product, doesn't mean warehouse is the sole control or sole custodian of the information about the inventory. So accounting is also responsible. The sales group too, they're also responsible. They must reflect how much of these goods have passed through them. So once a goods is moving to sales, accounting must be asking, they go to pay. So there's a accounting is what informed. Warehouse has issued the goods, so the sales group must reflect that into account so that that which has been collected must be paid. So at all levels, there is a share of real-time information that are being updated. So today's class, we have looked at the introduction to inventory management. We've seen how the inventory management processes have been done. We saw different types of movement of stock, which can be between unrestricted use to block use to quality inspection stock and all that. We saw movement from one particular plant to another. We even saw movement between different storage locations in a plant. And we laid emphasis that each of these movements must be backed up by a material document. And the key information that must be captured is the quantity of goods that has been moving around. So that is just an overview of the inventory management integration. So, for a brief recap, there are 3 questions here that we should just look at. So, for me to gauge your understanding of what we have just discussed. So, the first question here is talking about which of the following organizational data elements are used in inventory reports. There are 2 correct answers. So we all know that, okay, let me assume that some of us understand the way questions are to be asked in SAP, your XCP final exam. You see questions like, which of these 2 are correct? Which of these 2 is not correct? Which of these 3 correct? Which of these? So there's a combination. It could be 1, it could be 2, it could be 3, it could be not. So 2 answers, 3 answers, 1 answer as the case may be. So for this question, talking about which of the following organizational data elements are used in inventory report. So who wants to try? Who wants to give it a try? Let's try. Okay. Yes, I'm waiting. Who wants to try? Just give it a try. Which of these? Number 1, material. Number 2, purchase organization. Number 3, storage location. And the last one, plant. So which of these 2 can be regarded as organizational data element used in inventory reports? Yes. Let's give it a try. Who wants to?
Yeah, we have plants.
Plant, okay. And which other one?
And then storage location.
Okay, thank you. Storage location. Any contrary answer to that? Thank you, Benjamin. Any other contrary answer? He said storage location, C and D, and plant. Yes, you are very correct. So if you look at the organizational structure, let me just scroll down and take note. There are silent things that you can gain from here. This is just for the Zambike, but there are information you can see. You can see the client. You can see company codes. You can see plant. You can see storage location. So these are the 1, 2, 3, 4. These are the 4 basic inventory management organizational structure. So for inventory management, these are just the 4 basic. The company code, the plant, storage location. So the client, company code, plant, storage location are all data elements. Organizational. Yes, I think that is clear. So the second question, question 2 says, which of the following transactions can increase the value of inventory in a company? Which of the following transactions can increase the value of inventory in a company? There are 2 correct answers. Which of these transactions after completion, or which of these transactions can increase the value of inventory in a company? So who wants to give it a try? Benjamin has answered the first question, so I need the second question. Just a try. Wrong, maybe right, maybe wrong.
Good.
Good
Yeah.
issues and good receipt.
Okay. Damilola.
Good receipt.
Goods receipt. Okay.
Yes, sir.
And
Good issue.
goods issue.
Good.
Okay. He made a point. He said goods received and goods issued. Any other answer? Yes. Diago,
Good receipt,
Cheyi.
good receipt, post stock count.
Okay. We see another answer.
C and
Goods
D.
received. Okay. C and D. All right. Thank you very much for those answers. For Damilola, let's see. You said goods issue. When you issue, remember there's a silent word here. Increase. Increase. So we must be careful with word statements like this in our exam. You have to read in between the lines. Which are the following transactions and increase? So the first elimination here is that goods issue cannot increase because goods issue is already taken from the pool. Goods issue to the customer, goods issue to another plant, goods issue to another company code. So that's the first one. So the goods receipt definitely will increase. Will increase. And we have two options here now. Purchase order. Purchase order just means that you have placed an order. You have not received it. So purchase order will transform to goods receipts later on if it has been acknowledged by the vendor. So purchase order is not an answer. So post stock count. Post stock count. So once you have done your stock count, you have received your goods, you can post it. So there's a possibility of post stock count can increase the value of the inventory of a company. So those are the two answers: goods receipt and post stock count. The third question here says, which of the following goods movement can have an impact on financial accounting? There are two correct answers. So let's hear from other people. Which of the following goods movement are financial correct answers? One, from unrestricted use to stock in quality inspection. Number two, goods received for a transport order. Goods received for a transport order. Number C, plant to plant movement. Number D, goods issued to production. And number E, material to material, that is stock to stock movement. There are two answers. So which of these two answers?
C and D.
C and yes, I didn't hear that clearly.
C and D.
C and D. Okay, is a plant to plant movement, goods issue to production. Yes, that is that may be contentious. So who else? Let's try. Let's see possibilities. Who else want to try? C and D, or who else wants to give us another option? Who has a contrary answer to that?
B and C.
B and C. B and C. Okay, goods issue, goods receipt from a transport order. Okay, B and C. Okay. Let's do elimination. Goods movement. So the 5 of them are goods movement and can have impact. And which of them can have impact? So we're looking for those movements that have impact on financial accounting. Let's take the first option. From unrestricted use to stock in quality inspection. Can that have an impact on financial accounting? We are going to eliminate. So you just tell me why. So we can eliminate and then pick the best answer. So can movement from unrestricted use, I said unrestricted use are the number of goods you have that are available for production. Why stock in quality are just goods you take those quantity that you have on ground from the unrestricted to use as control. Some of them can be destroyed. Some of them can be used up. So which of these can it have an impact on financial accounting? Yes or no? It is one of the ways you can use to the exam. Anybody? I just want to hear opinion on that. Is it possible? Somebody wants to try? Okay, I'll leave that since. Let's move to the next one. Goods receipt for a transport order. Lusaka has a particular good from Mungwi. So that's a stock transport order. It's moving from Mungwi to Lusaka. Can that have a financial accounting backing? Can that? Let me call names.
Come again, sir.
Can it have a financial backing?
Come again, sir. Come again, sir. Yeah. Trying to...
Goods receipt for a transport order. Last transport order, we said, is the document you generate requesting for plant for goods from one plant to another plant. So that is the transport order. So Lusaka for finished products from Mungwi. And the question is, can that have impact on our financial accounting? Yes or no?
No, sir.
No. So B is
Yes,
not
sir.
an option. B is not part of the option. So goods received for transport order is not. Are we together? So we have eliminated B. So by extension, plant to plant movement within the same company code, we don't have a financial. Would that have financial implication? Is Kende Philip with us? Okay. Sheyi, Oluwa Sheyi, would that have a financial implication? Plant to plant movement, just like our option B, will not have financial impact.
No, sir.
Don't have. So B and C are off. It's still within the same company code because the company code have a central accounting system. Company codes are differentiated by a financial transaction and they are all financial autonomy. So plant to plant movement will not. It's still the same company code. Now, goods issued for production. Goods issued to production means it's still within the same plant. Are we getting it? It's still within the same plant from storage to production floor. So if plant to plant does not affect, definitely plant within a plant will not. So D is off. The short is the most obvious. It's the most obvious. Goods issued to production will not have any financial impact. We have just two options left, A and E. Now, let me now go back to my option of A. From unrestricted use to stock in quality means that stock in quality are values, they are assets. This stock were assets from unrestricted use, but they have not been condemned for inspection, out of which, if these products are declared to be faulty or default or in some destructive testing, these goods can be destroyed. This particular stock can be destroyed. So they are worse than scrap. If they are used up, definitely the number will reduce and that value will be lost. And I said they do not add. Quality inspection does not add value to your company. It's only telling you whether you are using good material or not. Are we together? So movement, that stock movement will have financial impact. So also, A and E, they are just the same thing. A is just more specific, unrestricted to quality inspection. E is more general, from stock to stock, from unrestricted to block stock. Block are damaged stocks or stock that you can't use. That will have financial impact. Or from unrestricted use to scrap, stock to stock movement. So these two will have financial impact on accounting. Please, any reaction to that? Any question to that? Yes, any reaction to that?
No, sir.
All right, is it clear, please?
Yes, sir, it's clear now.
All right, thank you very much. So that is the end of the class. So tomorrow will be a workshop. So the workshop will just, so I would advise us to lay your hands on the workshop. Try to do the workshop on your own. So go to the system, follow through the step by step. Tomorrow, I'll be here to address us and take some of our questions about the workshop. So thank you very much for your contribution and your attention today in class. So this video will be uploaded on, the link to the video will be pasted in the group for us to can also go back for a recap. So thank you. We'll see you tomorrow.
Thank you, sir.
All right.